Welcome everyone, welcome to this session. And first of all, let me share the agenda of today's class. We are going to discuss the practice exam question, which is practice exam 2. And our agenda is the discussion of question number 3 from this practice exam 2. As we did a question in yesterday's class, that was practice exam 3, question number 3. My pattern will remain same. Basically, as discussed, if any one of you have not joined previous session or sessions, so I can tell you one thing that how we deal these questions. First of all, we talk about the requirements and keeping the requirements in mind. Then we revise, we quickly recap the relevant areas. And then we do apply the knowledge on the actual question, which is there in practice exam 2. And we are going to attempt question number 3. So this question is for 20 marks because it's a section B type question, which is for 20 marks. There are 3 requirements for this question. Requirement 1 is from capital gain taxes. And within capital gain taxes, the relevant area, which is reorganization, or also termed as takeover. So his examiner has asked first requirement for 8 marks with respect to reorganization or takeover. Second requirement is for 4 marks, but that is pertaining to the first half, the first requirement. Again, in second requirement, there will be capital gain tax liability. Maybe the examiner has asked you savings in capital gain tax liability in case delaying the disposal of asset. You need to calculate any capital gain tax saving by delaying the asset disposal. So this part is purely pertaining to the discussion of requirement 1. And in the third requirement, which is also for 8 marks, examiner has asked you capital gain taxes and IST implications for 2 persons. You need to discuss IST and CGT implications for 2 persons. So there's a background of the question and the relevant areas which are examined in this practice exam 2, question number 3. Now, let's start discussing one by one and do a quick recap of the relevant things. Let's talk about number 1. Number 1 is with respect to reorganization or takeover. Before moving on, I would be happy if you share your thoughts. If you remember anything with respect to reorganization or takeover, can you explain this thing into 2 to 3 lines? If you can, so I'm looking towards the chat box and would really appreciate your efforts if you are participating. If you do know anything with respect to reorganization or takeover, just do type in the chat box. I'm just giving you 2 minutes time. Then I will start my discussion. What is reorganization? What you think? What exactly do you mean by this takeover or mergers? What happened at that time? Why we do study this thing in ATX? And what are the tax implications at time of reorganization or takeover? Just take 2 minutes time and put your thoughts in the chat box. Okay, I just got first comment. When one company buys all the shares in any other company, okay, fine. But is that necessary? A company should buy the shares of other company, or an individual can do the same thing? So answer is an individual can also buy or purchase or acquire the shareholding of other company. So this reorganization concept is there at both places, the capital gain taxes of individual and as well as the capital gain taxes for the companies. So this concept is a common concept which is normally tested for any of these two. Any other comments, any other points? Moses, thank you. Also noted your points. Anyone else, please? Whatsoever comes to your mind, just share your thoughts. My question is simple. Do you know anything what is reorganization or takeover and how we deal, what to do? Thank you, Zara, for sharing your statement. Existing shareholder get additional number of shares for free of cost. Yes. Another answer is one company buying the asset or whole shareholding of another company. Okay, fine. All of you are telling the relevant points. That's very good. It means you know the basic concepts. Okay, now I'm starting my discussion. And in the concept of the reorganization or takeover, normally at time of takeover, these transactions are held, which are like share for share exchange, or it is also termed as paper for paper exchange. Normally at time of reorganization or takeover, such transaction takes place like share for share exchange, also termed as paper for paper exchange. So what exactly happens at time of reorganization or takeover? For example, I'm just to apply this situation on yourselves, then you will be able to learn in a good manner. You acquired, for example, 15 shares at 2 each. It means you have invested an amount of 30 for buying the Z Limited shares. You have acquired 15 shares at 2 each. I'm just creating a scenario. So the same things are tested in part 1 of the question. At time of reorganization, what will be the CGT implication, how to deal the transaction, what happens at the time of reorganization, what exactly do you mean by the share for share exchange. So I'm just creating a scenario to make you understand. You purchased 15 shares at 2, you invested an amount of 30 in Z Limited. After few years or months, or after some time, a company named as, let's say, B Limited acquired the shareholding of company Z. B Limited acquired the shareholding of Z Limited. So basically, this time is termed as reorganization or takeover when a company is purchasing the shareholding of other company. So at time of reorganization, what can be done? So basically, the new acquirer company may offer few number of shares or cash or the loan notes to whom? To the existing shareholder of the investing company. You are the existing shareholder of company Z. Now company Z shareholding is being acquired by a new company which is named as B Limited. So at time of reorganization, B Limited would be offering you, being existing shareholder of company Z, this company can offer you multiple things. For example, company offered you, for example, 2 ordinary shares. Who is offering? Company B. To whom it is being offered? To the existing shareholder. All these offerings are made to you. For example, 1 preference share, and let's say 2 pounds cash per share. So these things are offered by B Limited to the existing shareholder of Z Limited. So basically it is termed as share for share exchange or paper for paper exchange. Why? Because you actually held the shareholding of company Z. Now the company Z has acquired by company B, and company B is offering all of these things to the existing shareholder, which are you. It means due to these transactions, due to such transaction, now you would be having multiple things in your hand. You are basically acquired shares in Z Limited, but now Z had been acquired by B Limited, and B Limited offer all of these things to you. So it means, for example, market value will be multiplied with the number of shares. Over here, the market value of the preference shares will be multiplied. Another thing can be given, which is like, as I told you, loan notes can also be offered to the existing shareholder. So there could be multiple things which can be offered to the existing shareholders. And then again, over here, the number of shares will be multiplied, the cash amount received per share. And let's say if the loan notes are also given by the new acquirer company, which is company B in this situation, to the existing shareholders. So effectively, your overall worth in the company will increase by due to XYZ things. What are these things? Because you received ordinary shares, you receive preference shares, you may receive cash per share, you may also receive loan notes. So all these things you would be receiving at time of reorganization in the form of share for share exchange, because company B is taking the shares of company Z, and you, instead of company Z shares, now you are getting the new things, the new ordinary shares of B Limited, new preference shares of B Limited, B Limited also paying cash per share, and also the loan notes to you. It means effectively your worth is going up. All of these things would lead towards the total worth. The next step, that is basically calculated the total worth which now you have at time of reorganization. But the important thing, these first two halves, these ordinary shares, what is the tax treatment, by the way? If you have ever studied, you should know the tax treatment. You are receiving maybe ordinary shares, maybe preference shares at time of reorganization. What is the tax treatment? Will these be taxed at time of reorganization, or will these be taxed in the future when you would be disposing any of these shares? I repeat my question. What is the tax treatment? Whether these shares are taxed at time of reorganization, or it will be taxed in future time period when you would be disposing the shareholding. What's your answer? What's your suggestion? All of you are giving the correct answers. That's very good. So these will be taxed. I'm not only talking about the ordinary shares. I have marked the preference shares as well. These would be taxed. In future, when the shares will be disposed of. But if we talk about specifically, if we talk about the cash element which received at time of reorganization, what is the tax treatment? Specifically for this cash which received at time of reorganization or takeover, what is the treatment for the cash element? This cash element, please don't forget this point, this cash element will be taxed immediately. Will be taxed immediately. What exactly do you mean by this thing? This cash element will be taxed immediately. You receive the cash amount. You are an individual person. You have to pay tax when this cash element is being received. So there will be CGT implication on the cash element received. What are the relevant steps? You would be recording the disposal proceed amount. Sir, we are not going to dispose cash. How we can dispose cash? So basically, the disposal proceed would be considered the same amount which you have received in the form of cash. So as I told you, the cash element will be taxed immediately. It means the capital gain tax will be calculated on this cash element immediately. Disposal proceed will be recorded, and disposal proceed will be that amount which is received in the form of cash. From this value, you would be deducting costs. Now, how to find the cost of the shares? For example, total worth, by adding all of these yellow highlighted things, the total worth is now, let's say, I'm just taking hypothetical figures, total worth is now 500. How this is calculated? Let's say 200, 100, 100, and 100. So basically, the total worth is now 2 plus 3, 4, and 5, 500. For each and everything, we can calculate the cost. For example, if you want to calculate the cost of ordinary shares, I'm talking about the first one, the cost of ordinary shares. So you would be taking the value of the ordinary shares divided by from a total worth and multiplied with the original cost, and original cost that was incurred, let's say that was 30. As I told you, I'm assuming all these things as hypothetical figures. Same case, as you have found the cost of the ordinary shares, the cash element cost would be calculated in the same manner. You will be taking the cash element value, which is 100 in this situation, to be divided by from the total worth, which is, we assume 500, into original cost. You invested originally, let's say 30, as you purchased 15 shares at 2 each. So the actual investment is 30. So by having this formula, a cost will be calculated. I repeat the formula: market value of the cash received, or the amount of the cash received, divided by total worth multiplied by original cost. So this is how you would be deducting cost from the disposal proceed and will end up with a gain or loss amount. The point is, at time of reorganization, apart from shares, if a person is also receiving the cash element, that cash element will be taxed immediately. Anything to ask? If there is any unclarity, you may please ask the questions, and if you guys are okay, do let me know, then we can move forward. So we have basically discussed a few things which are pertaining to the practice exam 2 question number 3 in the first requirement. So are you guys okay? If there is any unclarity with respect to any of these points, you may please ask. I'm waiting for your answers, please. Okay, now let's say I'm just adding and creating a scenario into the given situation. So the same is replicated in the exam question, which we are going to do after a few minutes. Let's say this reorganization or takeover is being held in the fiscal year 21-22. Assume company B acquiring Z Limited shares in the fiscal year 21-22. Let's say it means at time of reorganization or takeover, as we mark, this cash element will be taxed immediately. So it means a capital gain tax will be calculated in the year in which the transaction held. That is basically fiscal year 21-22. For surely this cash element will be taxed in the same fiscal year in which this transaction held. Now, let's say person also received the new shares in this fiscal year, but let's say if I ask you guys, if you want to dispose the shares, that shares could be ordinary shares, that shares could be, those shares could be preference shares. I'm not talking about the type of shares. It's a very generic requirement. If I ask you with respect to tax planning thing, we know one thing, that on this cash element, for surely there will be capital gain tax implications in the fiscal year 21-22, because this cash element is received in this fiscal year. adding a thing, asking a question. If you want to dispose of shareholding, although you are not restricted to dispose of shares whether in 2020, 21, 22, or in next year 22, 23, that's purely your choice. You are not restricted from anyone to dispose of shareholding. But considering tax planning thing, if you want to dispose the shares in the fiscal year 21, 22, that would be beneficial for you. Or if you delay the shares disposal, that will be benefit for you. What do you think? Considering this cash element has already been taxed in the fiscal year 21, 22. So would you like to dispose the shares in the same fiscal year, or you should delay the disposal of these shares? What do you think? Think with respect to annual exemption thing. Chandni Kaur, you are saying delay. Moses, your answer is I will prefer to delay. I'm with you. Delay to benefit, yes. Annual exemption, Hussein, delay. Okay, it means you got the relevant point. So that is basically the requirement 2 of the question. So, and basically this question is for asked for 4 marks. In this part of the question, you are required to calculate the capital gain tax saving, any possible capital gain tax saving by delaying the asset disposal. Then you should think with respect to annual exemption, there are already gains in the same fiscal year. If you are disposing any of these shares in the same fiscal year, it means your overall gains are going up. It means you are going to pay more tax liability in the same fiscal year. But if you delay the disposal of these shares, so it means the cash element gains will be covered by the annual exemption of 21, 22, and the next year disposal and the gains will be covered from the next year annual exemption 12,300. Okay, now let me show you the relevant requirements. So basically, for attempting these questions, planning aspect is very much important. Planning with respect to time management, planning with respect to marking scheme, planning with respect to the marks available, planning with respect to what to write, how to link the things, how to link the requirement with the scenario, how you can put your answer considering all of the aspects, considering requirements and the scenario. So basically, at professional level papers, these are the marks gaining things which you should consider before answering. Your planning is very much important. And my suggestion always for you is think more and write less. Read requirement carefully. After that reading, plan your answer, think more and write less. When you would be following this strategy, it means you are not writing anything irrelevant. You have planned the things, you are writing the relevant points. And if you are writing the relevant points and few points you have written which are pertaining to the marks available, so it means you are not wasting your time. In this situation, you would be able to pass your exam. Believe me, these are the key areas on which everyone like has to put some attention. So all of you can get pass ATX exam. Let me also show you the relevant scenario of the question. You should assume today's date is 7th December 22. 7th December 22 is in the fiscal year 22-23. Leiber has requested advice on the timing of the sale of shares which he acquired in a recent company takeover. Now you can see he acquired these shares in a reorganization or takeover and has requested advice on the timing of the sale of shares which he acquired through reorganization. His sister, it's about the first person, Leiber. Now let's talk about the second one. His sister, second person name is Vesta, requires advice on the tax consequences of making a lifetime gift rather than leaving an estate in her estate leaving the asset in her estate upon her death. So it means person is willing to know about the lifetime gift, and as I told you, it's basically asked in requirement 3, which we have not yet discussed. I would be discussing that as well, don't worry. The following exhibit available on the left hand slide screen provides information relevant to the question scenario and then requirement and response options. So here's a basic background. Now again, moving towards the requirements, the first requirement is for 8 marks, second requirement is for 4 marks, and this is how a 20 marks question is designed. In requirement A1, and that is requirement A2, explain. These words are very important to understand, to apply. Explain means you have to write, you have to narrate, but with the supporting calculations. The capital gain tax implications for LIBOR of the takeover of V Limited by MPLC. V Limited shares are being acquired by MPLC. So MPLC is an acquirer company and V Limited is an acquiring company, and you for surely LIBOR will be the shareholder of the V Limited. And this takeover is being held on 1st June 22. 1st June 22 is in the fiscal year 22-23, and a subsequent sale of his Mercury PLC shares on 1st Jan 23. 1st Jan 23 is also in the same fiscal year 22-23. So basically person received these shares through a takeover or reorganization in the fiscal year and planning to dispose the shares on 1st Jan 22, which is also falling in the same fiscal year. So you need to explain with the supporting calculation the CGT implications for LIBOR. Requirement B, B means A, requirement A2. Explain again. Your explanation should be supported with the relevant calculations. Explain with supporting calculations why it would be beneficial for LIBOR to sell his Mercury PLC shares on 1st May 23. By the way, when the person is planning to dispose of shareholding on 1st Jan 22, but in A2, why it would be beneficial for LIBOR to sell his shareholding on 1st May 23 instead of 1st Jan 23. So as I have told you the reason and you have identified the relevant area. So what are the benefits if both of the disposals are in the same fiscal year? So annual exemption is not enough to deduct from the gains, but if you delay the disposals and dispose the shares in the next year, then for surely next year annual exemption can also be claimed and deducted from the capital gains. Requirement B is advise V whether or not there could be two possibilities. There are any capital gain tax or inheritance tax advantages. You are not required to discuss about disadvantages. It's very, very important thing. If examiner has asked you, there are always pros and cons for everything. But if you are stick with the requirement, if you work requirement specific, for surely you will not be ignoring because advantages have asked. What are the IST and CGT advantages for herself? Herself means for Vesta or for Janice. If she were to give the investment property to J on 31st December 22 rather than leaving it to him in her estate on death. How you would be dividing the 8 marks by reading this requirement B. Plan what to do for attempting requirement B. Although we have not yet studied about scenario, we have not read the scenario, but without reading the scenario, still we can plan these. We can plan for these 8 marks. What will be your planning? Just think, write, note down by yourself. I'm not going to ask you that what you have written, what you have planned. I would be sharing my thoughts, so you will be having an idea that how you can plan better, plan more with respect to such questions requirements. I'm just talking about requirement B. Read the requirement, understand the requirement, and then plan what to do and what to write, which aspects are to be covered by looking at the requirement and the available marks. I will start my discussion right after 1 minute time. Okay, we should plan the requirement for 8 marks like there are two taxes to discuss, which are CGT and IST, and there are two persons for which we have to discuss these two things. It means we have to write at least 2 points for CGT for Vesta, 2 points for IST for Vesta, 2 points for CGT for J, and 2 points for IST for second person J. So this is how a total 8 marks requirement will be solved. You have to plan like this for every question, right? Don't waste your time by writing more or less. If you're writing more and more points, wasting time. If you are writing less, obviously you are compromising your available marks. So it means there are two taxes need to discuss for both persons. It means for every person, for V, at least 2 points should be given under CGT, 2 points should be given under IST. For second person, 2 points will with respect to capital gain taxes for J, and 2 points for under IST for J. And importantly, you should consider the advantages, not the disadvantages. Although there may be few disadvantages of the things, but if examiner has asked you to highlight the positive points, the advantages, so your answer tone should be should be at a positive note, right? Are you guys okay with this planning thing? Because here we need to tell the advantages and the tax implication under two types of taxes. So if you guys are okay with the planning of this question, then we can start attempting the part 1. First of all, now we'll read the scenario and then we'll solve the question. What about others, please? Thank you, Faisal, for your reply. All right, my dears. Read this scenario very, very carefully because I will be discussing multiple things while reading the question, then we'll start solving the same. It's about the first one. Is a UK resident and domiciled? If a person is UK resident and domiciled as well, it means then the person's overall worldwide gains are subject to UK taxes. I repeat, what exactly do you mean by this UK resident and domicile? If a person is UK resident and also UK domicile, then the worldwide gains for such person are subject to UK taxes. He has taxable income of 30,000 each year. What is the impact? Why this taxable income has given in this scenario? What comes to your mind? What clicks to your mind by having this statement in front of you? Why taxable income of 30,000 is mentioned here? Think. As I told you in previous session, nothing is given without any reason. There must be a reason for everything. Faisal, your answer is perfectly fine. It's not probably for surely to find the status of taxpayer to know about the tax band rate. Yes, both statements are correct. If you remember, the basic rate band limit is 37,700. This limit is firstly covered by the taxable income. Taxable income in this scenario is 30,000. Then this limit will be covered by the taxable gains. It means now the gains to the extent of 7,700, they can be fall in basic rate band. It means to this extent, capital gain tax will be at 10% and on the axis gains and on axis it will be at 20%. So basically this taxable income is given due to this reason to know about the available band limit. So to that extent, capital gain taxes are applicable at a lower rate of CGT. LIBOR acquisition of ordinary shares in Mercury PLC. LIBOR purchased 800 ordinary shares, which represents 40% holding in V Limited for 14,000 on 1st July 12. Okay. Mercury PLC, a new company, a new acquirer company, acquired 100% of the ordinary share capital of V on 1st June 22. A person acquired 40% shares in V Limited, and then V Limited is acquired by Mercury PLC on like after I guess 10 years time, because person acquired in 2012 and Mercury PLC acquired the shareholding on 22. In exchange for each ordinary shares in V Limited, LIBOR, the person received the following, that is basically share for share exchange transaction. 4 ordinary shares in MPLC valued at 20 per share immediately after the takeover and 15 cash. Mercury PLC has 200,000 issued ordinary shares. LIBOR has never been a director or employee of either V Limited or M Limited. Why it is written? You can easily gain 1 mark by looking at this point, and you can link this statement while answering your question. Why? What is the impact of this statement? What could be the link of this statement to our answer? Think. Perfectly answered, everyone. Very good. Very good to know. This statement is given because when there is a person who is employee or director of the company holding 5% more than 5% shares, and if the holding period is like of 2 years time period, more than 2 years time period, then the gains may qualify for BADR, business asset disposal relief, but both conditions should be met. Shareholding should be of more than 5%, person should be the employee of the company. But over here, if the person is not shareholder, so no BADR will be available. By looking at this statement, you can easily, you can get 0.5 mark at least. Just you need to link the things with the scenario. How? I will be doing that. I will be showing you. The takeover was for a bona fide commercial reasons and not for the avoidance of tax. Okay, fine. These transaction like share for share exchange, reorganization, all these transactions should be for a commercial reason and should not be due to tax avoidance. Then we have talked about the basic background of the person. Let's talk about LIBOR proposed transaction in Mercury PLC shares. You know, you may note one thing that LIBOR actually purchased a shareholding in V, now disposing the shares of M PLC. Where the V PLC shares have gone? Because against the V Limited shares, he received new shares from the Mercury PLC, and now the person is going to dispose the new acquired company which he received at time of reorganization. He has no longer shareholding in V Limited. Against V's shares, a new company, Mercury PLC, has given the shareholder new company shares, which are the AM PLC shares. LIBOR proposed transaction in AM PLC shares. LIBOR is now wishes to sell all of the shares in Mercury PLC. He has received an offer from an unconnected person to purchase these shares on 1st Jan 23 at a price of 28 per share. LIBOR would prefer to sell the shares to his nephew. Nephew is a connected person named as Dennis. However, this would delay the sale as his nephew will not have necessary funds to purchase the shares until 1st May 23. An unconnected person has offered to purchase shares, each share for 28, but he want to sell these shares to his nephew, but nephew at the time at present have no enough cash to purchase the shares, and his nephew want to purchase shares on 1st May 23. J has said he will also pay 28 per share. J is a nephew. Nephew is also agreed to pay to purchase the shares on the same price on which an unconnected person is going to purchase the shares. By the way, if nephew is agreed due to this relationship, because nephew is purchasing any shares, let's say if it is written as J has said he will also pay, like he will pay 25 per share. So what should we do? Should we consider this transaction if he sell the shares to nephew? Should we consider the transaction at the amount given, or should we consider the transaction at market value? What do you think? Right, your answer is right. Zara and Hussein, all of you. Each and every transaction should be recorded at arm's length price, which is the market value, effectively the fair value. So if it is written as his nephew is going to purchase the shares at less than market value, still any transaction in between connected person is also always recorded at market value. So I'm not going to read the further statement with respect to the second person, because if we talk about Vesta, so that's pertaining to requirement 2, effectively the third thing which examiner has asked in question under requirement 2, so that is pertaining to Vesta. I'm not for the time being going to read about Vesta. We are going to solve the first two requirements. A1, explain with the supporting calculation the capital gain tax implication for LIBOR of the takeover of V Limited by MPLC on this date and subsequent sale of Mercury PLC shares on 1st Jan 23. For 8 marks, very easy 8 marks. Explain with supporting calculation why it would be beneficial for LIBOR to sell his Mercury PLC shares on 1st May 23 instead of 1st Jan 23. By the way, examiner has not asked whether is there any benefit to sell the shares to a relationship to his nephew or to any other connected person. It's not like that, because the transaction in both situations will be recorded at the arm's length price. If he is going to sell the shareholding to any unconnected person or disposing the shareholding to nephew, in either case, the shares will be recorded at market value. So that's not also included in the requirement. However, in the requirement, it's purely examiner is purely asking about delaying the shares, whether delaying the disposal of shares will be beneficial for LIBOR or not. What should we do? How we can start? So be with me as we have read the scenario and requirement in detail. So I'm just creating it. And importantly, I will be solving all of these things in manual manner as we did the previous class question on platform. I'm going to explain you the things, and you are requested to solve the same question using the platform. Then you can share your answer, your presentation. If you want me to recheck, if you want me to check your presentation, your answer, how you deal the questions, you may please send after attempting the same on the platform. So that is the reason I'm not going to solve the same on the platform. Rather, I would be solving it using manual methods, and as I'm going to start my working here. So would appreciate your efforts if you please do the same question on the platform and do share with me. Right, you may share tomorrow or day after tomorrow, whenever you feel you are comfortable. You may attempt the question. If we talk about LIBOR basically acquired shareholding in a company on LIBOR actually acquired shareholding on 1st July 12th. He acquired 40% shareholding of V Limited, and he acquired 800 shares by paying 14,000 pounds. I'm taking all of this information from the scenario as we have read. After a few months or years, a new company named as Mercury PLC acquired 100% shares on 1st June 2022, and this date is basically falling in the fiscal year 22-23. And when MPLC acquired shares of V Limited, at the same time, this company offered, if you remember from the scenario, let me show you what happened at that time. In exchange of ordinary shares, V Limited, LIBOR received the following 4 ordinary shares at 20 per share and 15 cash. So considering these two things here, 4 ordinary shares, and the value of these ordinary shares at reorganization time is 20. By the way, if he is going to receive 4 ordinary share against existing against existing shares, so what will be the total number of shares? Okay, 3,200 shares. He is going to receive 3,200 shares. These are the number of new shares which LIBOR received by MPLC, and the market value of these shares at time of reorganization is 20. So effectively, a total worth of 64,000 is calculated. At the same time, he is also receiving against the 800 shares, he is also receiving cash per share, and that cash is basically 15 cash per share against the existing number of shares, which are 800 shares. So simply multiplying 15 cash per share into 800 shares. So can you please tell me the worth of cash received? 12,000. What is the total worth calculated? Total worth would be the sum of the value of the ordinary shares, which is 64,000. Value of the cash received, 12,000. So the total worth is basically 76,000. Why we have calculated this thing? Because in the next step, we need to calculate the cost of ordinary shares, and at the same time, cost of the cash element. Cost of the ordinary share will be calculated by taking the worth of the ordinary shares divided by, these are the number of shares. Worth of the ordinary shares is 64,000 divided by total worth of 76,000 multiplied by original investment. Originally, LIBOR invested 14,000 amount for purchasing V Limited shares. Which value is calculated? Can you please tell? Waiting for your answers, please. Yes, it would be available in the recorded format, don't worry. 11789. Thank you. 11789. Using the same pattern, we can also do calculate the cost of cash element. Worth of cash element is 12,000 to be divided by total worth of 76,000 multiplied by original cost. Originally, he invested an amount of 14,000. Which amount is calculated? 2211. Furthermore, this transaction is being take place in the 2223. Now, this cash element is to be taxed immediately. Tax immediately means this cash element is gonna tax in the fiscal year in which it received. How we can tax the cash element? I told you the formula. Take the disposal proceed, and disposal proceed will be the cash received amount, and cash received amount in this situation is 12,000. From this cash received, deduct the cost of the asset, and the cost of the asset is 2211. So the capital gains for this year are, what's the differential between these two? From 12,000, if we deduct, capital gains with respect to this transaction are 989789. Thank you, Faisal. 9789. Furthermore, if you look, he is planning to sell the shares on 1st Jan 23. Don't forget this thing, because examiner has asked you what will be the implications if his subsequent sale of the shares on 1st Jan 23. And he is planning to sell the shares on 1st Jan 23, the entire shareholding, all of the shares, to an unconnected person against 28 per share. So I'm considering the same transaction now. Disposing shares on 1st Jan 23, which is also in the fiscal year 22-23. As this transaction is in the same year, this gain is calculated in the fiscal year 22-23. If the person is also going to dispose the shareholding, the entire shareholding at this date, what will happen then? We shall be recording disposal proceed. All of the shares, what are the total number of shares? 3,200 shares, which he received from MPLC. All of these shares will be disposed at 28 per share. So a total value of 89,600 is calculated. Cost of the ordinary shares, we have already calculated this amount as the cost of the ordinary shares is 11789. After deducting this, the gain amount is simply calculated as 77811. Concluding this part, because we need to calculate the capital gain tax as we are working for requirement A, and in requirement A it is clearly mentioned that explain with the supporting calculation the CGT implications for LIBOR and subsequent sale of these shares. So these are the tax implications. This cash element will be taxed immediately. However, we have not written in the paragraph forms because I have left this statement on you that you have to write a proper answer considering these statements, these discussion points. You have to write this answer at your own, and you may share with me so I can check and let you know if there are any improvements needed. Let me write another thing with respect to here. As I told you that he is not the employer or director of the company. Why this statement has given? Because as he is disposing the number of shares, the shares of a company, but we can write a note over here: no business asset disposal relief is available on the disposal of the shares of MPLC. No BADR is available as LIBOR is not employee of MPLC. and also his, can you please tell me the new shareholding in MPLC and his shareholding? By the way, it was given in this scenario. If you check, you will come to know his current shareholding in the company. He has total shares in the company which are 3,200. MPLC has total share capital of 100,000 into 100. So his shareholding represents 1.6% of the company. You may link this point to your answer. No BADR is available on the disposal of these shares as Labour is not employee of MPLC, and also his shareholding is 1.6%, which is less than 5%. Where from we have checked this thing? I have shown you because company overall shareholding is also given in question. If we conclude fiscal year 22-23 both transactions, gain on cash element in the same fiscal year is 9789. Gain shares disposal gain is 77811. I have considered both figures from here. Both transactions are in 22-23. So the total gains for this fiscal year are 87,600. Please make me correct if I write any. From the total gains, we can deduct the annual exemption value. Annual exemption value is 12,300. After this, taxable gains amount is calculated as 75,300. Furthermore, from this scenario, I have marked one thing, that why the taxable income was given. Due to this reason, because to the extent of 7,700, this amount is available in the basic rate band. So what we can do is that from the total gains of 75,300, the first 7,700, to this extent capital gain tax is applicable at a lower rate, which is 10%. 770 is calculated, and the differential amount of 67,600, to this extent capital gain tax will remain at 20%. So 13520 is calculated. Adding both figures, you will end up with the value of 14290, and this is the total capital gain tax liability for the fiscal year 22-23. Last thing, want to ask from you, when this CGT liability is to be paid? Remember the date rule? Can you please tell when this CGT liability is to be paid? Is it 1st Jan or 31st Jan? Faisal, I guess it's a typo error. You know the date. Zara, your answer is right. Mustafa, your answer is right. Yes. This capital gain tax liability is to be paid 31st Jan after fiscal year. And we are talking about if any shares being disposed in the fiscal year 22-23, which starts from 6 April 22 and which will end on 5th April 23. After this date, the next 31st Jan will be on 31st Jan 24. So this liability is basically to be paid on 31st Jan 24. Why we have considered this statement? Why we have considered the timing of payment? Because it has a link with the second requirement, with the second part of requirement 1, where the person is going to delay the disposal of the shares. So basically, if he is going to delay the disposal of shares, it means it will also impact the tax payment date for the person on delaying the disposal of shares. Because Now both transactions are not in the same fiscal year, will not be in the same fiscal year. If he will be disposing the shares in the next fiscal year, ultimately it has an impact on the tax payment date as well. Read the second requirement again and try to solve it. Very easy for marks. Examiner is asking you explain with supporting calculations why it would be beneficial. From this thing, it is confirmed. It is a confirmed thing that there is a benefit because examiner is asking you to talk about benefit, or he's asking why it would be beneficial for Liber to sell his Mercury PLC shares on this date in the next fiscal year instead of 1st Jan 23. What will happen? How you are gonna present your answer in exam? What will be the capital gain tax liability saving? What will be the impact on the date of tax payment? So you have to consider all of these things. Let me mark here. We discuss the part A1 of the question. Now it's time to discuss about part A2 of the question. In part A, I'm just marking the heading and giving time you guys to plan your answer, to calculate few things at your own. If you're disposed on 1st May 23, it will be falling in the fiscal year 23-24. What will happen then? In such requirements where you need to calculate the tax saving, so you should consider the current situation as well as the proposed situation. You cannot do only work for next year. No, it's not like that. You should think about the transaction or transactions in 22-23 as well as in the next fiscal year 23-24. Why I'm not dividing it into two columns? Because previously in part A, one of the question, this cash element received in fiscal year 22-23, also the person was disposing the shareholding in the same fiscal year. So we added the gains of both transaction in the same fiscal year and calculated the tax liability. But if you want to calculate the tax saving or the tax implication, if there is if there is a delay in the shares disposal and person is going to dispose the shares in the next fiscal year, so you need to divide it into two columns, into two different fiscal years, then do work accordingly. If these both transactions are treated separately, what is the revised capital gain tax liability? Just perform a working at your own, and I will start my discussion right after 2 minutes. So have you calculated any amount? In part A of the question, both gains were in the same fiscal year, so we added both. But now in part A2, examiner is asking if it is beneficial for a person to delay the disposal of the share, what will happen then? So basically, gain on cash element will be taxed in the fiscal year 22-23, and the amount of this gain is 9789. If we solve this, annual exemption of the same fiscal year 22-23 will be deducted from here, although it is available 12,300, but here we are going to use a restricted annual exemption. Furthermore, gain on the shares disposal, if shares are being disposed in the next fiscal year, so any gains will be reported in the second column. What is the amount of gain? No need to calculate it twice because we have already performed calculations, and there will be no change in the answer, because if he sell these shares to his nephew on 1st May 23, still the share will be disposed at the same market value, which is 28 per share. So no need to revise this calculation. Just take the gain amount 77811 and place it into the next year column 77811. Now from these gains, annual exemption of 23-24, because the shares are being disposed in this year, we can deduct a separate annual exemption. Furthermore, first year gains are becoming nil. First year gains are becoming nil, whereas second year gains are becoming 65511. And you may also notice one thing, that he has taxable income of 30,000 each year. It means, considering this statement, if we want to apply the capital gain tax rate, CGT rates, for this year gains are already nil, but for these CGT rates, if we divide for the first 7,700, the rate will be 10%, because he has 30,000 income each year. So it means when to decide the capital gain tax rates, to the extent of the amount available in the first band, capital gain tax will be taxed at 10%, and a differential of 57811, they will be taxed at 20%. So finally, a revised capital gain tax liability is being calculated. So the capital gain tax liability for first year, as also highlighted by Faisal, is nil, and for second year is 770 plus. For second year for 22-23, can you please tell me 57811 into 20%? Which amount is calculated by multiplying 57811 into 20%? 1156. 1156. No, it's not. Okay, 11562. So the total liability for this year is calculated as 11562 and 770. Now it's basically 12332. Now you may feel a big difference. Once both transactions were in the same fiscal year, the total capital gain tax liability was 14290. But once the shares are delayed and disposal is in next fiscal year, the overall capital gain tax liability is a lower amount as compared to the existing scenario. So finally, we can conclude this part requirement is, if he delays, if LIBOR delays the disposal of shares till next year 23-24, then CGT liability would be saved by, let me check the answer which is given by is from 1958 by 1958. How we did calculate this amount? Consider the existing 14290 CGT liability 14290 and proposed delay in the disposal. In that situation, only an amount of 12332 is a liability. So basically, by delaying the disposal of shares, effectively there is a capital gain tax liability saved by 1958. And second important point, as any gains which are there in the fiscal year 22-23, then relevant CGT will be paid 31st Jan after fiscal year. So the date is 31st Jan 24. Now, and also these gains are in the fiscal year. These gains, this CGT liability is calculated for the fiscal year 23-24. So I'm also marking another point, and also would be having more time to pay capital gain tax, as 23-24 CGT liability is to be settled by 31st Jan 2025. If we dispose of shares in 22-23, then relevant CGT is to be paid on 31st Jan 24. But if we delayed the disposal for a few months, then you can see there is also an impact. Apart from the tax saving of 1958, apart from the tax saving of 1958, there is also the person is having more time to settle the tax liability and can pay capital gain taxes till 31st Jan 25. Are you guys okay with that? Requirements 1, part A and part 2. We have attempted the first two parts till now, and we discussed all of these things in very much detail and also revised the relevant areas while solving these part A and A1 and A2 of the question. Are you guys okay? We also have planned for answering part B of the question, advise V whether or not there are any CGT or IST advantages for herself or for J if you were to give the investment property to J on 31st December 22 rather than leaving it to him in her estate on death. This requirement is for 8 marks, and we have planned that how should we answer for 8 marks requirement here. There are 2 persons and there are 2 heads to be discussed. So it means for each person under each head, at least there should be 2 points. So this is how we shall be giving 8 points in our answer and would be getting 8 marks. 1 mark for each point. Let me show you the scenario as well. Let's talk about Vesta. Because at the start of the question in the basic background, Vesta is a sister of Liber. It's about the second person. His sister Vesta requires advice on the tax consequences of making lifetime gift rather than leaving an asset in the state upon her death. So let's talk about Vesta. V is 66-year-old and has never married or had a civil partner. Okay, is in ill health and expected to be die at some point within the next tax year 23-24. Has not made has made no disposals for CGT purposes in the tax year 22-23 to date, and will not make any in the tax year 23-24. Means no assets are disposed for CGT purposes. He has made one lifetime gift of 350,000 cash to her son Janice on 1st June 22, that is in the fiscal year 22-23. For CGT purposes, has not made any capital gain taxes, has not made any disposal of assets in these both fiscal years, but for IST purposes, cash is transferred to son on 1st June 22, which is in the fiscal year 22-23. So basically, the requirement is pertaining to the next heading, that is Vesta investment property. We owns an investment property which has never been as main residence. Okay. Current market value of the property is less than the price we paid it for it, and its value is expected to fall further throughout the tax year 23-24. V is considering gifting of the investment property to J in her lifetime rather than leaving it to him in her estate on death. J is a sole beneficiary of V's estate. Scenario is in front of you. I'm not directly going to solve the question. Rather, I would happy to discuss the implications. But before my discussion, I would appreciate if you please plan few things at your own. Vesta, its previous background, its further proposal is in front of you. Also, the requirement and the related planning with respect to this requirement is in front of you. So you have to think all of these points at your own, and then we can start discussing the tax implication, whether there are any advantages for V or for J, if the asset is being transferred in life or at time of death. So multiple things are to consider while answering this part of the question. It's 22 past 10 at my end. I will start my discussion right after 6 minutes time. So you can also think at your own. If you want, I can show the question. You may take the snapshot of the question scenario, and also you may take the snapshot of the requirement and the related planning. So I'm giving you 7 to 8 minutes time just to plan what should be included in our answer, how we can write, what we can write in these points for getting 1 mark for each separate point. Hopefully, you all are investing time for solving the requirement considering current situation. Two minutes to go. After 2 minutes, I start my discussion with respect to Vesta, its existing situation, proposed transfer, and the relevant CGT and IHT implications under Part B of the question for 8 marks. All right. So let's discuss with respect to capital gain taxes for both persons separately. Simply, we can mark a heading capital gain tax and IST implications on gifting of investment property on the defined date, which is 31st December 22. If Vesta is transferring this asset in her lifetime on 31st December 22, what will be the implications under capital gain taxes for both persons? As we have read the scenario in much detail, now let's talk about basically if we add, we should at least discuss 2 points, 2 points, 4 points under capital gain taxes. Which points are relevant in the discussion. Hopefully you have planned your answer, but now you may compare. If we talk about with respect to capital gain taxes, if we talk about with respect to capital gains, by the way, we need to discuss with respect to Vesta and Janus. At least 2 points here, 2 points here. What are these 2 points for Vesta? If this asset under both situations transferred in lifetime or not transferred in lifetime, what will happen if Vesta has not transferred asset in life, has not transferred in life, then for surely this asset will be added to state. Who is the owner? Vesta is the owner. If she has not transferred this asset, has not transferred the asset in life, then for surely this asset will be added to tax estate. And if an asset is added to tax estate, it means no capital gain tax on such asset. Let's talk about second situation. If he has transferred the asset in life, what will happen? Have you concluded any point? It was written in this scenario, the market value of the property is less than the price which we paid for it, and its value is expected to fall further throughout the tax year 23-24. If the person is transferring any asset, then from the disposal proceed cost will be deducted. Disposal proceed is lower, cost is higher. So if she transfer asset in life, then there will be a loss. Is there any benefit for Vesta for having this loss? No, because in the same fiscal year, she has not transferred any other assets. So from which gains this loss can be adjusted. So it means Vesta is indifferent for transferring this asset in life or at time of death. There will be no capital gain tax implication under both situation. If the asset is transferred in life, then there will be a loss, but this loss cannot be adjusted with any other gains because the person has not made any other disposal in the same fiscal year. Is this thing clear? The capital gain tax implications for first persons are clear. V is indifferent if you transfer asset in life or transfer the asset at time of death. It will has no capital gain tax implications at all. Even if this situation, if there is a loss, but this loss cannot be adjusted with any other gains because the person has not disposed any other asset in the same fiscal year. Is that clear? All right. Let's talk about with respect to the second person. By the way, a general discussion then would be linking this to the answer of the question. For example, today date is 2021. Let's say there is a person one, there is a person two. The disposal proceed of this person will be considered as cost of the other person. In 2021, asset value, let's say, is 100. First person would be disposing this asset at 100. For second person, this cost will be at 100. I'm just creating a scenario, then would be linking as we discussed for first person. So same discussion will be for second person under the ambit of capital gains taxes. Let's say this asset is not transferred in 2021. If this asset is transferred in fiscal year 21-22. Now what you think, considering this fact, asset value is continuously falling. So what you think, whether next year disposal will be at high price or at a lower price? For surely it will go down. For example, again, the current market value of the asset has now declined from 100 to 80. So the cost of the first person would be considered, the disposal portion of first person would be considered as cost for the other person. Now, which situation is beneficial? A very important discussion, a very important point, very important question from you guys. With respect to this person, Janice, what is beneficial for J? That what is his wish? Whether she get, whether this person, whether he should get this asset in 2021 or in 2022? Because for this person, cost, or we can also mark this cost as base cost. So it's not the cost, it's actually the base cost. So whether base cost is a lower amount is better or a higher amount is better? If you are Janice, and if a person wants to transfer an asset, and if asset value is continuously going down, so what will be your wish? To get asset in early years or in later years? Because if you get asset in early years, your base cost will be high, and higher base cost is beneficial for you because the overall gains will go down then. But if you are getting the same asset after next year or after a few years, then considering current situation, the asset is value is continuously going down. It means in future years your base cost will be a lower amount. If base cost is going down, it means ultimately your gains will be high. Yes, Esther, and all of the comments, your understanding is perfectly fine. High amount of base cost is good because the higher amount of base cost will then deducted from the disposal portion, which will result in a lower chargeable gains. So for second person, if person is getting asset in early year, not as part of the death state, then for CGT purposes, it is good because a higher amount as base cost will be considered if this person want this asset to sell in the future years. So for J's point of view, as we concluded from Vesta's point of view, for Vesta's point of view, whether the person is transferring this asset in life or whether at time of death state, this person will remain indifferent from capital gain tax purposes. But if we talk about the second person, for J, it would be beneficial that J will get asset early years, so that a higher base cost will be calculated, and this higher base cost is a good thing for future disposal if the Janus want to dispose the asset in the next years. So hopefully you got all of these points. And in case if you have any unclarity or disagreement, you may please ask, you may please discuss. Now let's talk about IST. If we talk about with respect to IST, by the way, as I have told you that you guys would be writing a formal answer, the proper answer, considering all of these discussions which are doing right now. You have to narrate all of these things as I have shown you with the help of example and has linked the things to the scenario. You have to narrate, you have to write your answer in a formal manner, and then you can share with me. I will check that. Now discuss the same thing under the ambit of IST. If we talk about Vesta, if this person transferred asset in life or at time of death, what will happen? If person is transferring this asset in life from IST purposes, from IST perspective, it will be treated as PAT. PAT exempt at transfer. If this asset is transferring an asset in life, so this transfer is PAT and is exempt at time of transfer. Further implications for this transferor, if dies within 7 years, then taper relief would be available, and for surely for availing taper relief, the minimum time gap between the transfer date and the death date should be 3 to 4 years. So these are the tax implications for transferring PAT in life. And if transfer dies more than 7 years time, then simply this PAT will remain exempt at time of death. And if Vesta has not transferred the asset in life, if the asset is being transferred at time of death, so this asset would be added to estate value, and considering the current situation, asset value is going down and down year on year. And would be added to, and a reduced value will be added to estate. By the way, is there any tax implication for this transferor, whether the person is transferring asset in life or transferring asset at time of death? No, there are no such implication for the transferor, as there were no implication for the transfer under capital gain taxes. Same case for the transferor, there are no implications under IST as well. Let's talk about the second person. Second person is a person who is going to get this asset. The name of the person is Janice. Let's talk about Janice's point of view. We normally read a concept named as the value of the asset is falling. Can you please tell me the relevant concept name? I do remember, for surely I do remember, but I want to listen from your side. If asset value is falling year on year, and if the asset is transferred in life, but now the person has expired, then due to that decline in the value of the asset, very good. Ijaz and Faisal and all of you, Moses, your answer is fine. Fall in value relief. So it means if this asset is transferred to J, for IST purposes, it will be considered as PAT. But if V is going to die, we are talking about the implications for Janus. V is the transfer. If transfer is going to die within 7 years, and asset become taxable, now asset is held by Janus, and this asset will become taxable, but a fall in value relief is available. To whom it is available? To the person who is holding this asset at time of death. There is a condition attached. If the asset is being held at time of donor's death, or asset has sold at arm's length transaction, in both situations, fall in value relief can be claimed. So these are the implications for Janice, who is holding asset at time of death. This asset, if becomes taxable due to 7-year rule, but still there would be a relief available for J, and resultingly no capital gain tax liability would be calculated. And you may also consider further points over here, like taper relief would be available if the transfer dies within 7 years and all that. So the rest of the things are exactly the same as we have discussed many points over here. But as far as IST implications are concerned, you would be writing it in the paragraph form. So at least you should make at least 4 points. So 4 points for both persons in under IST and 4 points for both persons under capital gain taxes. So this is how you would be getting 8 marks in total. So we are done with the discussion of this planned question, which was question number 3 of the practice exam 2. And it was our last question and the last day for session. I have further more questions video if you guys are interested to learn that how to attempt the questions on the practice platform. You may please ask. I would be sharing the detailed discussion, the detailed videos of the questions which we attempted, like as we have done so far practice exam 3, the first 3 questions, and for practice exam 2, the question number 3. So in the same manner, we have other questions videos as well. So in case if you wish to learn, you may please ask. And furthermore, if you all of these would be shared on the WhatsApp group, don't worry. And it's all from my side. um, I'm going to wrap up now and wishing you very good luck for your exam, for your preparation. And my prayers and my efforts are always with you. In case if you feel difficulty, you may please write in the WhatsApp group. Other peers, myself, Sir Kambaraza, we are all there to respond you, to help you till your exam, till the time you pass your paper. Ijaz, the advice is just try to maximize your practice. You are asking any advice for last 5 days. My humble request to all of you is to maximize your practice on CBE practice platform, because it is the same weapon which you would be using during your exam time. So if you are not using the same weapon while practicing your questions at your home, then how you are going to get success in real exam time? So my humble request is to attempt more and more and more questions using CBE practice platform. And importantly, just I prepared this table just to highlight that how you can plan your answer. It's not like that as these 3 lines paragraph is given and you are like starting in your own way, you are not planning anything. No, 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 that's not the way to pass exam. So you, for every question, you think like this. You like over here we planned this part 2 is linked to part A1. Then we planned the answer in the same, and we answered in a structural manner. So these things are very important to discuss, to prepare at your own. Yes, Susan, you may before ending it from my side, again let me write my number. So in case anyone, 92322378731 2. If any one of you have not yet added to WhatsApp group, please write. We shall be adding you, and we shall also be providing you the relevant notes, stuff, and the video recordings. By the way, video recordings have already been uploaded on the Scrubber Academy's YouTube channel. In case if you are attempting any other paper along with ATX, so you may also follow the workshops and the revision marathons from the Scrubber Academy's YouTube channel. 92322378731 is my contact number. In case of any question, query, help, you may please write. And we welcome you always. My prayers, my best wishes are with you. Take care, bye, and thanks for your time. Thanks for joining session. Take care, my dears. Allah Hafiz. You are welcome, Moses. You are welcome, Zara. All of you, you are welcome. Take care. Bye.